All right, ladies and gentlemen, we are coming live from our Joburg office. Good morning and welcome back to the opening bell with myself, Tshepo and Ashley. And this is brought to you by TD Markets and TD Markets Academy every Mondays to Fridays at 9, streaming live on YouTube. All right, let's get right into it, guys. Today, all eyes are on the non-farm payrolls. That is what's making headlines today than the US non-farm payrolls, right? So we're going to talk a little bit more about it. And obviously, this will be a prelude to the actual live stream on the NFP, which is going to take place later on today at 2 p.m. All right. So live on YouTube at 2 p.m. Do join us for our monthly NFP report. All right. So this report, this report is arguably the most important macro release of the month, and more especially since the market is trying to answer one question, all right, which is the US economy slowing, or is it merely cooling? That is the question. Is the US economy slowing, or is it merely cooling? Now, if you take a look at the current consensus forecast, which is around 80,000 to 105,000 new jobs, with the unemployment rate expected to remain at 4.3%. All right. And earlier on this week, we had the ADP payrolls as well as the job openings, which have been surprisingly resilient, although weekly jobless claims have ticked higher. All right. So that is what we had. These are the two reports we had earlier on this week. And the headline jobs report is, of course, the NFP. All right. So looking at the current consensus, right, I'm leaning more towards a slightly stronger than expected figure. I'm leaning more to a slightly stronger than expected figure. All right. And my reasons for that is the ADP report, or the ADP reported about 122,000 private sector jobs. The George job openings recently surprised to the upside. Layoffs remain relatively low despite softer hiring, right? So the US labor market appears to be in a low hire, low fire environment rather than a recessionary one. So how the markets could react then is that if we get a strong report, anything above 120,000 new jobs, this would signal that the US economy remains resilient despite Middle East tension, despite elevated oil prices, trade uncertainty, tight financial conditions. All right. And the likely market reaction from that is that the US dollar could strengthen if we see a higher than expected figure, right, above 120,000. The US dollar could strengthen. So you would see your GBP USD going down, your Euro USD going down, and it would pressurize gold, right? Would see also gold going down. Gold will come under pressure as well, right? Which means rate cut expectations might get pushed further out. And equities could continue the rally. And yeah, so this would be the likeliest market reaction, all right? Now, what if we get a report between 80,000 to 110 or 100,000 jobs? This would probably be the outcome equity markets would like the most, right? Why? Because it would indicate the economy is still growing, inflation pressures are not re-escalating, and the Fed Reserve can remain patient on their rate cuts, right? In this case, stocks will likely grind higher, bonds yields stay relatively stable. Bitcoin is going to be an interesting one because it could recover, and other risk assets, right? We could get a recovery from there, and emerging markets may perform reasonably well. All right. And then a weak report, anything below 80,000. This is the scenario that could trigger the biggest market move at the moment, because the markets are not pricing in any weak report at the moment. Looking at the previous report, which came better than expected, and that other report coming out better than expected, markets are not pricing in a weak report, right? And as a result, if the report comes in weak, then we could get big movements, right? And investors would start to question whether high energy prices are hurting growth, corporate earnings is slowing materially, the US economy is heading towards a sharp downturn, and the reaction from that, or the effect from that, is that stocks would sell off, right? Treasury bonds would rally, the dollar would weaken, and gold would rise. I know that a lot of us look at gold whenever there's important US macro releases. We tend to look at gold, what gold is doing. That'll give us an outlook, an idea of what's happening around the world, right? As far as gold prices are concerned. So a weak report would weaken the dollar, would strengthen gold, but a stronger report would strengthen the dollar, which means the gold prices would come under pressure. And then markets increase bets on future rate cuts, right? So that is basically a quick rundown or summation of the outcomes, all right? But now what we don't pay careful attention to is that the NFP is the headline job report, right? You guys know that during the NFP week, the market starts with the JOLTS job openings, which usually gets released on a Tuesday, followed by the ADP employment change report, which is the day later, and then you get your unemployment claims, right? And then to complete the week, we've got growth earnings, we've got the actual non-farm report, and the unemployment claims, right? From the beginning of the week with the JOLTS job openings, that is the start of the jobs report, right? The jobs report, even though the non-farm payroll is the one that is the headline report. But a lot of people are not keeping an eye on the unemployment rate as well. The unemployment rate, right? If payroll growth is weak and is bad, but unemployment stays at 4.3%, markets may shrug it off, right? If unemployment unexpectedly rise to 4.4% or higher, that could be interpreted as the first meaningful sign of a weakening or deteriorating labor market, and that could weigh on the US dollar. So that's something to consider, right? And yeah, so basically combining all of these things together, right? Combining the payrolls report, unemployment claims, unemployment rate, and wage growth could give you a really good understanding of how the markets could react, right? Although sometimes we get mixed signals, right? So looking at the data right now and looking at the past NFP report, personally, I'm leaning towards a stronger figure, which would mean that gold prices would be under pressure as a result of what? As a result of a stronger dollar. As a result of the stronger dollar. So that is what we'll be looking at. All right. So ladies and gentlemen, that's basically the non-farm payroll. This is a prelude to what's going to be coming at 2 p.m. right? So we will be going through the charts at 2 p.m. Ash will be with me. We'll be going through the charts, and we will wait for the report to come out to see what we can get out of that. All right. But for this morning, that's a quick summation of the NFP. All right. So let's look forward to later on, guys. We will definitely catch you later on the live stream on YouTube. But for this morning, hope you guys enjoyed, hope you guys learned. And yeah, that is the opening bell for this morning. All right. So we're going to end it here, guys. Have a good one. Have a good day. We'll see you guys later on. Cheers, everyone.